Good afternoon, ladies and gentlemen. Apologies, a little bit late starting there. I don't have my technical help and reminders coming at me as I normally do. So I've just brought up the trades for the week there. As you can see in yellow, I still have 4 trades open. Predominantly gold, 3 in gold, 1 in the Dow from yesterday. The other trades from today are already closed. Obviously the key things to pick out as usual are those marked in red, which are the trades that have stopped out. So 2 gold trades on Monday, both stopped out. A DAX trade on Tuesday as the market fell away. Yesterday was a pretty ugly day all round for me. Carried a couple of Dow positions overnight, and whilst the Dow futures opened up a little bit firmer last night before the Asian trading session, they fell away during that session, and I stopped out on one of those positions with a negative 409 pip or a loss of 409 pips on that particular trade, and that was after being stopped out earlier on the day on a couple of Dow trades as well. Largely misreading the unemployment numbers in terms of the increase that was coming in there, and then some of the negativity that surrounded these complaints against Apple, and a fall off in the technology stocks as well. Couple of gold position, or 1 gold position carried over as well. So gold worked a little bit better for me yesterday, but still trading from the short side. We're trading up around the 1900 level at this particular point. I think the first thing is, based on some of the questions that came in, and there's been some good questions coming through again today, and I'll get round to answering those in a few minutes. One of the conversations, or one of the questions that came in last week, was in relation to gold, and I've been pretty much wrong with gold all week, whereas I think it was Stuart Grant who came in with the question last week. His analogy in relation to gold was correct, and again throughout the course of this week we've seen some price targets that have been raised from Goldman Sachs and a number of other analysts and brokers that have done that as well, with a target of about $2,000 on gold. And as much as I can sit here in front of you today and suggest that's not going to happen, I did the same last week, so I'm not going to do that. As much as I do believe that we're going to encounter resistance here at 1900 and possibly fall away from it, we have effectively no interest rate. We have a very weak dollar, and for those reasons gold potentially can stay at these elevated levels for some time to come. I think the key will be looking for when that dollar starts to increase in strength, and then potentially we see a sell-off in gold. Interest rates are going nowhere, I don't think, for the foreseeable future, so there's nothing there that's really going to push those markets. But the strength of those analyst recommendations, or those targets that were set, in particular Goldman Sachs. When Goldman Sachs say something, everybody sits up and listens. And the rally to 1800, I believe, was on the back of a Goldman Sachs price target, and then the elevation of that price target to $2,000 this week has caused another big run up to the upside. But as I've already mentioned, I do think that we will encounter resistance here between 1900 and 1905, and potentially will fall away. So when I think it comes to gold, I think sometimes we're best to bring Stuart back onto the program and let him to have his thoughts. So And I'm going to do that, but I'm going to use myself to give those thoughts. So what Stuart was seeing with gold, and I'll bring gold up as we're talking about this. So we have the gold market here, currently trading just above that 1900 level, 1901, 67, and you can see we are encountering resistance up about 1905. Sorry, let me just draw that line in a little bit better. So between 1905 1906, I've got a 15-minute chart up here. I think if I take this down to a minute, you'll see that we probably did go a little bit higher than that. So you see there on the minute chart, we did go a little bit higher, but not too much at all. So we'll go back to the 15-minute chart, and what you do tend to see when we see these rallies, and it's surprising how quickly and how easily we went through that big figure at 1900, and you can see the extent of the move there. And I was thinking about closing a trade around this particular level when I was short at 1889 or 1890 earlier in the day, but then we've had a fairly steep rally from about 1 o'clock this afternoon all the way up from 1892 up to 1905 before we've turned. Obviously it is a Friday, there are going to be people adjusting their positions ahead of the weekend. There is a little bit of negativity in the equity markets at the moment, and we can look at those prices in a second, but I would expect, and I do expect, there to be a bit of a sell-off in gold coming into the close. So in relation to Stuart's thoughts, he's looking for a pullback to around the 1870 level, which is off of this chart at the moment, then back up through 1900. We've already seen that today, and then a slow move upwards towards the $2,000 level, and he's not looking for some of the dramatic moves that we've seen to this point. He describes it more as a slow grind towards the $2,000 level. So and that may well be the case, and I'm not going to contradict anything that he says this week, because whilst I didn't contradict it last week, I did suggest that there were two types of opinion, and you do need differences of opinion in order to be able to trade. I do think still running into the weekend now that we could see gold a little bit lower than we currently see. It was exactly the same yesterday, a bit of a sell-off in gold before we saw a late rally back up to levels that we'd seen earlier in the day. So we'll just have a quick look at the Dow, and I think just in relation to what's going to happen in the last part of trading today, there is still some weakness in the Dow. We rallied there briefly up back towards 26,500, didn't quite reach it. This morning we rallied up to 26,530, but we've fallen away again, and if we continue to see this weakness in the Dow, there is a chance that we'll see a spike back up in gold, but with the weekend it could well be that we see a sell-off in both of those. So we'll continue to monitor that throughout the remainder of the afternoon. There's a number of questions that have come in today for me, and which I'll do my best to answer them all in the next few minutes. I think there's a few, the majority of them are about stops, number one, and with the week that's been in it, and with the way that my own positions have gone, as much as I look at the week, and the week is a positive week and is going to end up with more profit in the bank, the last couple of days with living the last couple of days, it's impossible to feel that you haven't been beaten up over those last 2 days, and that's predominantly because the move in the indices yesterday I was the wrong side of, and I've pretty much been the wrong side of gold all week, but yet there have been a number of trades, and a large number of trades, that have returned small profits, and the cumulative effect of all of those is that I show profit on the week. So one of the key questions is about where do I set my targets, and many of you will have done education courses where they talk about the RRR, the relative risk return, the risk return ratio. There's another and where everything is based on a multiple in terms of the stop or the risk that you put onto the trade. I'm very much a believer that you have to adapt to market conditions, and the quicker you adapt to market conditions, the safer you will be if you're in a difficult trading period, or the more profitable you will be. And setting very rigid targets is really not for me. So the way that I try to describe it is that I will start thinking about taking a profit when I hit a certain level. And that level is usually around 25 pips or 25 points of a movement. Now, if you're seeing added momentum coming into the market at that point, you let the trade run. But if you're struggling to move above that 20-25 pip point movement, then take profit. There's no point trying to labour the trade and hitting a return of 3 times your risk before you get out of the trade, because you may never see it. So it's the more rigid you are about your rule structures, and it's important that you have rules, and it's important that you have risk management tools in place as well, but the more rigid you are about that, the more difficulty you're going to find yourself in from time to time. The number of people that you talk to who have a set target based on the risk that they've placed on the trade, and moving their stops to entry, more often than not they get stopped out, and they're left kicking themselves that they didn't take the profit when it was available. Many people, and I think I've spoken previously about stops and moving stops to your entry point. Yes, it protects you, but if you get stopped out every time you do it, it's a pointless exercise. I would much prefer to take the profit and get back into the trade as the market moves back down to those sort of levels. Equally so with the type of trading that I do, which is day trading. As much as you can use technicals, and the big technicals that I would heavily rely on are going to be from daily charts, and maybe from a 4-hourly chart that's going to give you some fairly strong technicals and levels that you can trade off of. You're not going to hit those levels every day, so you can sit about for the week and maybe trade 2 or 3 times. So a lot of what I do is more based around the prevailing sentiment on the day. So I'm not going to be in a situation where I can give you a lot of technical indicators that are going to suggest this is the entry point or this is the exit point. A lot of what I do is looking at the price movement, and I think the way that I prefer to trade, so rather than thinking about more, very, very closely about where my entry and where my exit point is, that there are certain times of the day that I like to trade, and I think there are patterns that form during the course of the day. They're not always the same pattern, because that would always make it very, very easy. But I think there's good movement early in the morning with there's good movement early in the morning before 8 a.m. So that's one period of the day that I like to trade. I think between about 9:45 and 11 a.m. in the morning, you see another movement. A lot of that has been to the upside over the last number of weeks. It tends to be led by the DAX, but the Dow futures very quickly follow. So that's another period that I'm looking at. And then you have pre-open in the US, and you can break that down into 2 periods. You've got the period where gold and the currency start to move, probably between about 12:45 and 1:30 in the afternoon. And then you have the equity markets, which will have a movement around the open from about 2 o'clock to 2:45 in the afternoon. So those are the blocks that I like to trade in, and it's about sentiment around those periods. So as you could see with today's trade, and you do get, you get a 50-60 point around the opening bell in New York. You get a 60-point movement to the upside, to the downside, very, very quickly, and more often than not you get both. So if you're right about the position during that period, it can be enough of a pip or point return to make your whole day. So it's those chunks of the day that I like to trade in, and what I really focus in on are the patterns that I see over those particular periods. We all know that we need volatility to trade. If you don't have volatility, the market's going nowhere, and that there won't be a profit as much as there won't be a loss. But that sort of eradicates the reason for trying to trade these markets. So for me, those are the periods that have more volatility, therefore they have more price action, therefore they have more of a movement in one direction or the other, and that's when I want to be trading. There's no point sitting at your screen for 12 or 13 hours a day trying to force trades when the market's not moving, because you will just be handing money back. So I'm very clearly looking for the periods that move more often and in bigger movements than in other parts of the day. I don't like butting my head too much with the American markets. You have some really big players, and when they have a big trade to do, regardless of whether you've got the technicals right or whether you've got the sentiment right during that period, that particular trade is going to move the market in the direction that they dictate. So if I can look at those brackets of the day where I can make money and I can be finished by 2:30 in the afternoon, then I'm happy with that, and that's what they're the periods that I'm trying to focus on. I think one of the things, and just leading on from that, one of the things that that caused some of the difficulties that I faced yesterday, or some of the losses that I faced yesterday, was the fact that I was trading too long into the day, and had I shut up shop around 2:30 in the afternoon, the picture would have been very, very different. The last trade, for instance, that I took in the Dow, I wouldn't have been holding, and I wouldn't have had the issue of running that overnight. So hopefully that gives you a better idea around stops and targets in particular. So just to clarify, because I know I'm running out of time, with targets, there is no predefined target. Like everybody, I want to catch a movement, and I want to catch a quick, fast movement to either the upside or the downside, depending on which way the trade is pointing. But if I see a movement of 20 to 25 pips, 20 to 25 points, I am going to consider taking profit. But if I see that there is still momentum in that trade, or we are still trending or moving in that particular direction, I am naturally, of course, going to let it run. But if I see it sticking, I'd much rather take the profit and get back into the trade if we drop back to the level where I really entered into the trade. So I like to repeat, and you'll see that in the trading that I do. I like to repeat trades during the course of the day. In terms of stops, the conditions that you're trading in, I think, are important. I think the more rigid I think everybody should have a hard stop. I think when I'm trading, and I'm trading my own positions as I am here, of course, I always look at it in cognizance to the profit that's gone before, from that particular day and from the week. And if I've had a good week, I'm prepared to give the trade a little bit more breathing space, and sometimes that is to the detriment of the P&L as that trade gets stopped out, or there's a big overnight move. I would suggest that you have stops, certainly in the Dow of 150 points, the DAX maybe 75 pips, and gold 100 as well, and have those as fairly hard stops. If I then give my trade a little bit more breathing space, you always have the opportunity to get back in if we see a movement back to the upside. But that's I think one of the things that you'll need to understand over time is that I don't really have any hard and fast rules. It's very much about adapting to the market at that particular time. Hopefully that's answered most of the questions. If there are any that I haven't got round to, I'll try to email over the next 24 to 36 hours and give you a response to the question that you put in. Thank you very much for joining me, and have a good weekend.